Good morning, I'm Nicholas and you are watching The Hot Topic. This week's hot topic is the Chinese Renminbi, also known as the yuan. In a surprise move on Tuesday, the People's Republic of China raised its dollar CNY rate by 1.9%, reaching 6.43 per dollar, its weakest point since August 2011. This devaluation saw the CNY suffer its biggest one-day loss in 20 years. China adopted market exchange rates in 1994, and the yuan has never seen such a massive drop in just one day since. But that's not all. On Wednesday, China threw another curveball at the financial markets by devaluing the yuan again for a second day in a row. Let's see what actually happened. China sets a daily midpoint for the value of the yuan against the US dollar, allowing it to trade 2% above or below that rate. As of this week, the yuan's fixing will be based on the yuan's close in the previous trading session. And the result was, the yuan against the US dollar was lowered 1.9% on Tuesday from the previous day, and a further 1.6% on Wednesday. So what led to such drastic action on the part of the Chinese government? A highly possible reason is that by devaluing its currency, China is giving a boost to its exports. Data released over the last weekend showed overseas sales fell 8.3% in July, adding weight to this theory. Despite assurances by Beijing, currencies, commodities and stocks fell sharply across the region as investors fear a slowing of the Chinese economy. And what does this mean for the global markets? Well, the German DAX fell by a huge 6% in 2 days, and the China A50 index lost more than 2%. But the damage doesn't stop there. Countries that rely on Chinese imports have suddenly found extended costs for their goods, leading to a drop in demand and subsequently sales. Australia, Japan, New Zealand, and many other Asian countries like Korea are feeling the pinch. The Nikkei fell 1.6% and Australia's S&P 200 dropped by more than 3%. The Australian dollar hit a 6-year low after a heavy sell-off on Tuesday. But the repercussions go further afield with both US and European stocks taking a hit. The UK FTSE, for example, fell almost 2%. What might we see in the future? The US has for years pushed the Chinese Republic to free float its currency, as currently they have an unfair advantage over competition. China says with this move it's doing just that, by allowing market forces to dictate the next day's range, a positive step in the eyes of the International Monetary Fund. However, fears were sparked of a possible currency war. Even with Beijing's assurances that there won't be any sustained depreciation of the yuan, whether the market believes it or not will depend on what China will do next. What do you think China's next move will be? Comment below and let us know your thoughts. I'm Nicholas and you have been watching The Hot Topic.